You want to know, what are the best stocks to buy now? Did you know that you can use stock screeners to find new investing ideas? Today, I'm going to provide 5 growth stocks that are buys now, the best stocks to buy according to Seeking Alpha. Today, I'm using Seeking Alpha's stock screeners. Now, a stock screener is there just to give you ideas to explore. You shouldn't buy or sell just because you saw something on a screener. So in Seeking Alpha, you click this button right here, and there's a stock screener. And what I did is I scrolled down to top growth stocks right here. From here, click on advanced filters. You want to make sure to click the sector and industry. Then go to edit filters, and the market cap, we're going to use $10 billion. And today, we're focused on growth, and I'm going to use information technology. So tech stocks that are growth stocks. For growth, the default is A to A+. We're going to slide that A- to A+. And the first stock that comes up is going to be Credo Technology Group. The ticker is CRDO. This is $11.62 billion market cap. Now, before someone says it in the comments, depending on where you're from, you might pronounce this as Credo. I've listened to several conference calls, and the company pronounces it Credo. So what does this company do? It makes a unique cable product called an active electric cable, or AEC. This is basically like the fabric for data centers. So it connects data center servers to network switches. And this company claims to have some of the fastest electrical cables in the market. This is going to compete against companies like Broadcom and Micron Technologies, which I do own in my portfolio. Of course, growth in the AI market is huge. And of course, with that comes premiums to the stock price. You can see the 4P ratio is 136.44. Does have strong revenue growth, 48% year over year, has about 4% short interest. In fact, this article here from just a couple days ago shows 63.6% year over year growth and anticipates 126% growth in Q3. Of course, that's driven by AI and data center demands. So if you're buying the stock at $69, you're definitely late to the party. Now, you might be thinking to yourself, well, Eric is usually on top of these AI names. You know, he created that list back in January 2023, top AI stocks to buy. This stock wasn't on the list, and he missed the run. In fact, this stock is up 275% year to date. So why didn't Eric and Fired Up Wealth buy the stock? I'm very disciplined as a long-term investor, and I have rules of engagement. And if certain stocks do not fit criteria, or if they break a rule or a red flag, I don't touch them. I don't care where the stock goes. I just have to be very disciplined to my own methodology. And the reason that I didn't buy this is I have a rule. I will not buy a stock if it's held in the Cayman Islands. Now, we don't have time to go into a lot of detail on this, but that's your answer. It's headquartered in the Cayman Islands, and therefore, it's a no touch for me personally. Of course, you do whatever's best with your money. Now, if you follow this channel, you already know that Taiwan Semiconductor produces at least 90% of the world's most advanced chips. So when you're thinking about Nvidia GPUs and data center GPUs, Taiwan Semiconductor basically has a monopoly, at least right now. In fact, the nation of Taiwan and its companies hold a 68% market share of all global chip production. These numbers are staggering, and we talk about how semiconductors are the new oil and explain why things like the CHIPS Act is a good thing, because we want to bring this production onto U.S. soil. There's a ton of geopolitical risk when you think of tensions between China, the U.S., Taiwan, and I don't think that most people understand just how big of a deal this really is. If something were to happen to Taiwan, the entire global economy would completely collapse. Pretty much everything has semiconductors and chips in it these days. From this microphone to your iPhone, computers, you name it, it has chips in it, and Taiwan is that leader. So Taiwan Semiconductor is the next stock on that screener. If you're not familiar, it's what we call a foundry. So a fabless company like an Nvidia or an AMD, even Apple, they send their designs to Taiwan Semiconductor, and Taiwan Semiconductor actually produces those chips. If you look at the revenue by technology in the most recent quarter, this is going to be in nanometers, this NM. So 5 at 32%, 7, 17%, and so on. But revenue by platform, this is where it gets really interesting. So smartphone is 34%. A lot of that's going to be Apple. HPC, that stands for high performance computing. This is basically data center. Automotive is only 5% right now. Internet of Things, 7%. But essentially data centers and really generative AI as a whole, it can't exist without Taiwan Semiconductor. This is the ultimate pick and shovel play for AI stocks. You can see the growth on Seeking Alpha, pretty solid here. Forward revenue growth, 14%. Profitability, very strong, A+. Valuation wise, it's not crazy expensive. It's it's not dirt cheap, but the PE forward gap 27.73, that peg gap TTM 1.64. It does pay a 1.2% dividend, market cap $833 billion. So this is heading to $1 trillion. The reason it doesn't carry even a higher premium is a lot of people don't invest in this stock because of the Chinese risks. But it is important to understand if something does happen to Taiwan Semiconductor, it's not like Nvidia or Apple or any of its customers are going to be immune. Now, I don't own the individual stock, but I have tons of semiconductor ETF exposure, not only in my primary taxable brokerage, $2.6 million, but also my retirement accounts has semiconductor ETF exposure. The stock is up 91% over the past year, up 85% year to date. So again, if you're buying this stock, even if you think it's a great long-term investment, you are chasing a little bit. This is one of those stocks that you probably have to just periodically dollar cost average, buy a little bit every paycheck, or you wait for a significant pullback, which who knows when that's going to happen. This next stock is all about data in motion. Every time we use our smartphone, say we order an Uber, we kind of take for granted what happens behind the scenes. When you order that Uber, you can see exactly where the car is at. You can see exactly when it's going to pull up. And it's basically real-time data. When we use things like phone apps, data is constantly streaming in real time, providing information and updates. And of course, there are a lot of complexities behind the scenes, and this next stock helps all of this come to fruition. And I used Uber as an example. In fact, Uber was the streaming company of the year for Confluent. And some of the stats are absolutely mind-boggling. 138 million messages a second. This is just with Uber. 7.7 petabytes a day. So traditional data architecture is an absolute mess, as you can see on your screen. Confluent calls themselves the new paradigm for data in motion, and they call it data streaming. So it connects all these apps and processes that data, streams the data, governs the data, provides data products like AI modeling and fraud, recommendations, personalizations, payments, inventory. So from a giant mess to a central nervous system, Confluent is the data streaming platform that makes all this happen. You can see some of the customers here, lots of big names, everything from Square, SAP, you've got Netflix and TiVo, Ticketmaster, financial services, healthcare, and more. Here are some of the use cases across all different industries. So for finance and banking, for example, early on fraud detection, transportation for fleet management, retail for things like inventory management, personalized promotions, and more. So historically, this was an open source model. Of course, with a lot of these open source models, they're going more towards that cloud services model. And so this is going to be a cloud SaaS name. We're going to use things like EV/NTM revenue when you're looking at valuation. This stock is just under 10 at 9.9x for that EV/NTM revenue. That rule of 40, you want 40% or higher. This is actually 25%, so it's a little light. Net dollar retention is pretty strong at 117%, and free cash flow is basically at par and heading in the right direction. I do own this stock, and I do like it as a long-term investment, a 5-year hold. It's one of those that's burning cash, not profitable yet, but it is heading in the right direction. I'm long on Confluent. The ticker is CFLT, and I think this one will do well over the next several years. Now, the fourth stock on the list deals with memory. And for most people, when you think of memory, you think, well, that's just a commodity. The thing about Micron, though, is it does have what they call a wide economic moat. Now, why is that? Well, it's because it has a vertically integrated supply chain, also strong research and development capabilities and partnerships. And when you think about memory and AI, memory is essential to extend the frontier of AI capabilities. Multiple vectors will drive AI memory demand over the next several years. That includes growing model sizes, input token requirements, multi-agent solutions, continuous training, and more. And one that sticks out here to me is workloads from cloud to edge. Traditionally, most processing was done in the cloud, and that data was basically translated back into your device, like your computer. So when you think of data centers, that's going to be your GPUs, like Nvidia. Computer chips for a laptop, something like an AMD or an Intel CPU. What's coming next with AI laptops, AI hardware, is going to be what's called neural processing units, or NPUs. And this will require more memory. Micron is a high quality business. The profitability grade here on Seeking Alpha, A+. That growth is pretty solid as well. You're looking at 43% forward revenue growth. Micron does pay a small dividend yield, 0.45%. The stock has 3.1% short interest. Market cap on this, $113 billion. And the stock's only up about 14% year to date right now. Now, of course, if you look at the 52-week high, this was $157 $1 stock. The 52-week low was $78.63, and it's trading under $100 right now at $98 a share. So this could be an attractive stock to take a closer look at. The fifth stock on the list, this is a bit of a niche player. This is going to be a SaaS play software focused on construction management. Procore helps with three primary categories. So owners and developers, you can see things like Starbucks, general contractors, and specialty contractors. 17,000 total customers, over 2 million active users. The ticker is PCOR. It's up about 18% year to date. This is a $12 billion market cap, 6.15% short interest, so be aware of that. And that 4 PE ratio on Seeking Alpha is a 77.71. If you're new here, make sure you smash that subscribe button and the bell for notifications so you don't miss the next video. If this video is helpful to you, please return the favor. Drop me a like, drop me a comment. Have a great rest of your day. Take care.